and we're going to move forward. Okay, so I'm going to share my screen. You guys, I am excited. I don't know about you, but today is all about growing your wealth. When you think about growing your wealth, a lot of people think of the money aspect of it and knowing that, it takes money to grow your wealth. But there are some key things that you should have in place. And we're going to talk about four of those things today that can significantly improve your wealth, significantly improve your life, and make sure that you are on the right path to growing your wealth. So today, I would like for everyone to, and it says heart health, but it's not the heart health. If you can check in to the event on Facebook, go to Growing Your Wealth. It's on WHOW organization. But if you go and you check in, it's not to the heart health because that was last month. Go to Growing Your Wealth, and also make sure you like us on Facebook, our Facebook page. We would love to hear from you. We want to get to network with you and see what type of businesses that you have, that so that you can help women in our area, because we're all about women helping other women. And of course, we are going to do a giveaway. So to enter to win that giveaway, you go to www.wownetwork.org/win. Again, that's wownetwork.org/win. And we hope that you win. Today, all of our prizes are going to be cashed because guess what? This is all about growing your wealth. So each person that wins is going to win a cash prize of $5 to $10. So we hope that you enter so that that can be yours and you can be on the first step to growing your wealth. Of course, just so everyone knows, WHOW stands for Women Helping Other Women, and we empower women to improve their economic status through education, employment, and entrepreneurship. You can come and with us, you will learn, grow, and empower others to do the same. Now we're going to start with our corporate prayer, and today that is going to be led by me. Dear Heavenly Father, we thank you for this time that we are able to fellowship with each other, Lord God. We thank you that the women that are on this call are going to be empowered to improve their wealth. They're going to increase their economic status. They're going to use the tools and resources that we have in place so that they can do the things they need to do. God, we thank you for that today. We thank you that the women are touched and they're blessed and they're able to receive the word that they're going to hear from the wonderful speakers that we've lined up today. In Jesus' name we pray. Amen. So when you think of keys to building your wealth, one of the first keys to building your wealth would be to building an emergency fund. You need to have at least 3 to 6 months worth of expenses set aside in a savings account before you start investing. And don't touch it unless it's a real emergency. And guess what, guys? Christmas shopping, Valentine's Day, all the other holidays, 4th of July, those are not considered emergency fund. And that's not what should be used. Your emergency fund should not be used for those things. It should be used for things that really can help you. So to make sure that we are on target with this, today we are going to hear from a CPA and director of tax and accounting from Post and Tax. And this is a pre-recorded, so I'm just going to go ahead and pull it up. Just a moment. Let me find it. Just a second. We're going to start it over.
My name is Corey Snelson. I get the opportunity to work with Polston Tax in business development, and I get the pleasure to introduce to you the speaker, Whitney Craig. Whitney Craig is an Oklahoma native, born in Ada and raised in Bixby. At the suggestion of her father, Whitney started studying accounting at the University of Oklahoma and received her bachelor's in business administration in accounting. Whitney went on to earn her MBA from the University of Central Oklahoma. Whitney began her work at Polston Tax and Accounting as an intern and has worked her way up to the Director of Tax and Accounting. Each client situation is so different from the other, and helping thousands of clients in different industries means her job is never boring. Whitney's work lets them do what they do best while she takes care of the rest. Her department allows clients to focus on what matters to them most while she and her team are working tirelessly behind the scenes, keeping them in compliance with the IRS and state, and to help avoid scary and stressful situations that can often arise from being neglectful with their taxes. Now, it is my pleasure to hand it over to Whitney Craig.
All right. Thank you so much, Corey, for the introduction, and thank you all for having me. It's always exciting for me to speak about taxes. I know it's not everybody's favorite subject, and for a lot of people, it's money taken out of your paycheck or big payments you're writing the IRS or the state every quarter. But for me, what I enjoy about it is my job is to kind of give that strategy to my clients to help reduce that number as much as possible. So I'm excited to be here today, just kind of going over a few tips of things you want to consider in order to make sure you're maximizing your deductions and really paying your fair share, but not more than that. So just to kind of jump into this today, one of the first things that I look at whenever I'm meeting with the client and looking at strategies is how are they structured? So there's several different type of tax structures that you can choose in regards to how you want to file, and I'll just kind of touch on a few of those today. And the first one is a Schedule C. So if somebody comes into the office and they're set up as a Schedule C, it's definitely something that is kind of a red flag in my mind. Just to kind of give you some details on a Schedule C, this means you're filing on your personal tax return, your business activity. And one of the things that is kind of a downfall of this type of tax structure is whenever you're an employee with a company, they're withholding taxes out of your paycheck and then they're matching that and then forwarding it on to the IRS. So in the situation of the Schedule C, you're actually responsible for both of those portions. So it's what's called self-employment tax. If you haven't heard of that and you're set up as a Schedule C, definitely talk to your tax professional about that. Essentially what that means is you are paying not only your ordinary income tax rate, just like everybody else, but on top of that, you're paying an additional 15% approximately. So depending on what tax rate you fall in, if you're adding another 15% on top of that, that's a substantial amount of taxes we're talking about for your federal taxes. And that's not even considering that state side of things. So definitely something, it's an easy way to be set up if you're wanting to jump in and just get your business going. But as far as long-term strategies for taxes, you want to kind of look at these other options. Kind of a second option for structure is what's called a partnership. This just means that there's more than one person that is conducting a business. And we kind of run into that same situation with self-employment tax typically with that structure, because even though it's a separate filing for your business taxes, it's still flowing through to you on a K-1 that's subject to that self-employment tax typically. So kind of looking at pros and cons, Schedule C and partnership have that SE tax piece that isn't necessarily ideal, which kind of leads me into the third tax structure, which is an S Corp. This is essentially an election that you can make to request that the IRS let you file as an entity that at the end of the day, you're going to pay what you can say self-employment tax on just your wages as an officer, and that's it. The rest of the income that you earn from your business just flows through to you on a K-1 form, and you don't pay that self-employment tax on it. So that is the benefit. You have to have a reasonable wage amount that's set, but at the end of the day, you are not going to see that additional 15% on everything that you're earning. So the other piece of this that kind of leads me into the fourth type of tax structure, which is a C Corp. With the C Corp, you're not going to have that same flexibility that you have with an S Corp. So for instance, with an S Corporation, if you take money out of your business, so a client tells me they want to kind of have the funds for their business, they use it for their personal life, they're taking funds out consistently, then a C Corp may not be the ideal situation, just because, yeah, you have these great tax rates that they implemented with the Tax Cuts and Jobs Act of 21%. But if you take money out of that C Corp, you're going to pay double taxes. The C Corp can't deduct the money that you're taking out as an owner, and then you have to report it as a dividend on your personal taxes. So just kind of considering like long-term goals of your company, if you want to have flexibility to take money out of your business when considering that double taxation, a C Corp may not be your best choice, even if it does have those really good tax rates. So again, just a discussion to kind of have with your tax professional about what really meets your long-term goals there, and at the end of the day, what gives you that best bottom line number for your tax situation. Other than kind of tax structure, another thing that is common for us to just kind of analyze is how we can best look at separating out revenue streams. So just to give you an example, we had a client who was a doctor, and they had 3 different activities just running through one LLC, one company. Their property that they use for the business, a weight loss clinic, and a general practice, family practice, all just running through one entity. So kind of first red flag with that is just for liability purposes on a separate note from taxes, it's definitely ideal to kind of break out different activities like that, and at least have that conversation with a professional that can make sure you're structured in that way that best protects you. But secondly, even in the instance of an audit with the IRS, for example, we all have that chance of getting audited. None of us want to be that person that gets selected, but there is always that chance that we will be. And especially as a business owner, you want to make sure that everything is very clean, defined, and separated. And really for business purposes, other than just liability, just having a clean set of books for each one, each activity is ideal. So in this instance, we had looked at, with the Tax Cuts and Jobs Act, they had implemented the qualified business deduction, which is a 20% deduction essentially on qualified business net income. And the family practice piece of this client's income was not qualifying. So there's certain businesses that aren't eligible for this 20% deduction, and a doctor's practice is one of them. So what we did was we kind of separated out those 3 entity or activities, I guess, rather, to separate companies, and that client was able to take that 20% deduction on not only the property piece, but also on the weight loss clinic. So all in all, just looking at, okay, how are you structured? What kind of deductions are out there with, QBI, and what's going to get that lowest bill? And that kind of result was about $70,000 in taxes saved. So something to talk about. I mean, for the typical taxpayer, the Internal Revenue Code is way too complicated. That's why we do what we do. It's constantly changing, and you definitely want to be proactive about that and look at, okay, yes, this may be the easiest way for me to be set up, not have to worry about restructuring things, but how much money are you really losing by not considering that piece? So separating out revenue streams, the structure, definitely key points to keep in mind. whenever you're looking at, how can you save money on ultimately the tax bill that you're going to get. So another thing, I kind of referenced long-term goals, but one thing that you want to consider if you have a situation where you're really thinking of selling, say 5 to 10 years down the road, that is another piece where kind of strategy comes into play. There is a qualified small business stock exclusion for capital gains that you can qualify for if you're set up right. So if somebody comes in, meets with me and says, this is kind of what I'm thinking, I'm going to sell, and they are not set up as a C Corp, that's something that I want to consider and kind of advise them, hey, this is an option, and it can essentially save you all of your capital gains up to $10 million when you sell the business. So instead of paying that huge capital gain tax on the sale of your entity, you're not going to have to see that tax effect. So looking at what long-term options there are and what your goals are is another important piece of saving on your taxes as well. And then another thing I just wanted to mention is just in regards to loopholes. There's a specific thing they call the Augusta loophole that essentially allows for people who are renting out their personal residence and it's less than 15 days of the tax year, you do not actually have to claim that income in your income taxes at the end of the day. So part of the Internal Revenue Code that you can use strategically, especially if you have a business and you use that personal residence for events, something to consider if you're not leasing out to your business. Hey, that's an option that you want to look at. So keep that in mind. And then as far as just kind of additional tax tips, kind of went over just some tax strategy items to consider. But 2020 tax filings are obviously coming up very quickly. And wanted to kind of give an update in regards to the deadline for any businesses located in Oklahoma or individuals. The IRS did issue out a notice stating that any individuals or businesses affected by the recent severe storm that occurred, that started February 8th, that you are able to actually have an extension on several different items as far as filings and deadlines. So this is huge if you have been busy this year, you're thinking, oh my gosh, I have to try to file before April 15th, March 15th, that's coming up on Monday. You're in luck because they have extended that out for Oklahoma residents and certain Texas residents that have been affected by that. So June 15th, any deadline that occurs between February 8th and June 15th is now June 15th. So for instance, individual business filings, any quarterly payroll tax is due on April 30th, and the first quarter estimated tax payment, which is huge, that's due April 15th, typically is now due June 15th. So that's just kind of a few key items. Additionally, just on a personal level, if you were trying to make an IRA contribution in 2020 to save, that's going to be June 15th as well. So keep that in mind as you go file. It should be an automatic something that they recognize automatically when the IRS sees that you file. But if you do get a notice in error, just call that number on the notice and reach out and say, hey, I'm in this area, all 77 counties of Oklahoma. So I should not be subject to any penalties in regards to filing after April 15th. So that's important information for people who are kind of stressed about the deadline coming up. The other big item for 2020, your tax professionals are going to be asking you, this kind of big question for this year is, did you receive your stimulus payments, your economic impact payments? That is one thing that a lot of people probably don't understand, that those payments that were issued by the IRS were related to really just basing it off of 2018 and 2019 tax information. So if you had income that was too high to qualify for those impact payments for 18 and 19, and then 2020, your income was lower, you really have this opportunity now in your 2020 tax return to file the recovery rebate credit and get that money on your tax return. So
All right, you guys, that was the 15 minutes of the pre-recorded live. Hold on just a second. Let me spotlight myself. How did you guys feel about that? Any updates or anything? I know today technical issues have been very live, but we the importance of what just happened is a lot of people don't understand what tax is like and how significant it is to your wealth. And she just gave a lot of tools. So let's talk about it. Did anybody have any questions? You can put them in the chat or you can unmute yourself at this time and we can discuss that. Anyone? Let me see if I can unmute. Camilla or Tasha, I know we had a conversation right
Sure.
before
I
this
just,
conversation.
yeah, so I was, thinking how important it is to make sure your business structure is set up well and that you have a professional helping you so that you can, like she said at the very beginning, pay your fair share, but not have to pay any extra. So make sure that
Yes.
all your taxes are going in correctly and you're not going to get stuck.
Exactly. And we have a member of WOW, actually Next Gen, Cindy McGee. She is one of our tax professionals. Poston is another one. If you find yourself in a situation where you feel that taxes is going to stop you from creating your wealth and building your wealth, then those are the two people that you can reach out to. Cindy McGee, Next Gen, which you can find her on Facebook, as well as I will put the information for Poston tax on the screen. Just a moment. So if you're looking, you can reach out to Corey Snelson. She is the business development in the business development department. And you can go to Corey at postontax.com. You can reach her at her toll-free number, 844-841-9857. You can also reach her at 918-551 7060, which is the office number, or you can text her cell phone 918-801-1023. And if you're in the Tulsa area, we actually have a networking event that we go to every Tuesday from 12:30 to 1:30. If you're looking to get or connect with her directly, you can go directly to that meeting and meet some of the wonderful ladies. So again, we're going to save the giveaways for the end, but we have how many? Three wonderful giveaways at the end, and it's going to be a cash prize. So make sure you sign up because today is all about growing your wealth. So why wouldn't we help you to grow your wealth? So another step of key ways to build your wealth, which I found through Dave Ramsey, which is very, very helpful, is getting out of debt, staying out of debt. Let's get one thing straight. The only good debt is paid off debt. The more money you send to banks and loan payments, the less money you have to save and invest for your future. So another aspect of that or debt, one of the biggest ones is credit card debt. But there's a secret word in that. And the secret word is credit. You guys, your credit can really, really affect your wealth. So today I have the lovely Miss Tasha Stewart, who is a Financial Dream Team LLC, the founder of her own credit restoration assistance. She is going to talk to you today about the importance of your credit and how it kind of plays into building your wealth. So I'm going to stop sharing my screen. Tasha, are you there?
Yes, I'm here. Can you hear me loud and clear?
I can. Hold on,
Great, great.
I got myself spotlighted.
Okay,
There you go.
you can stay spotlighted. It don't matter.
No, no, I'm okay. But she is going to talk to us today about, I'm going to let her just take the floor. This lady is a powerhouse and she has some wonderful tips about doing your credit and things that can help you. So we're just going to dive right in and let her take the floor. Tasha, take it over.
Good afternoon, everyone. As Crystal just mentioned, I am a founder of Financial Dream Team LLC, and I also have a network called Lady CEO, and I am a proud member of the WHOW organization. But I wanted to build a organization and be a part of an organization to help women. I had a passion to help women because women, we have a problem with circulating money. We have a problem with investing money. We have a problem with saving money. And so I came up with this catchy little phrase, and I was helping women build finances, well, faith in finances. And just a little bit about my story, how I even got into credit repair, because I started like many of women here in America, is that we didn't understand credit at all. We didn't understand the importance of credit. So back in 2016, my husband and I thought, like everyone else, we had the money to purchase a home or the money to start a business. But unfortunately, lenders and financial institutions wasn't worried about how much money we had in our pocket or even in the bank. They wanted to see our credit report. They wanted to see them three little digits. And if you think back decades ago, like when your grandparents were living, or if they're still living. But when they were going to buy things, large purchases of things, they didn't have to go off of a credit score or their credit report. It was their character. So for instance, my grandfather, Richard Urban, he was a farmer. He worked at Tinker back in the day. His wife was a home baker, and, they had 5 children and all these good, great things. And because they had great character, they were approved. Versus somebody that has bad character. And that's one misconception that we have when we go to these financial institutions. We think, oh, well, they're going to understand, our story that we lost our job, or, a death happened in our family, or, I became ill, or we think that they're going to understand them stories, and they're not. And so what I had to sit back and ask myself back in 2016, because when I got denied, I was frustrated. I was mad because I'm like, I'm worthy to get, $100,000 or $200,000 to purchase a home. But then I began to ask myself, would I really loan myself $100,000? I had late payments. I had charge-offs. I had derogatory marks. And I didn't even have anything current that was over 6 months that could display that I could handle $100,000. The highest credit card I had at that time was $500. So here I am asking for $100,000, but I only have $500 worth of credit. And if they pulled my bank account, I had no money in savings, and I had about $32 in checking, and I did not get paid for another 2 weeks. So we have to start really looking into this and not getting upset when we get denied, and let's find a solution to help us out. I always tell, my clients, and even I had to tell myself, I wanted to live the American dream, but yet I was living the American struggle because I had credit card debt. I had more bills than I had income coming in. I had all of these things against me, and I felt like, well, I just have to live with this debt for the rest of my life, or wait for 7 years to get it removed. And so I began to get into credit restoration. So in 2016, my husband and I enrolled into credit restoration, and we felt like this was going to be our genie in a bottle, right? Because credit restoration is supposed to wipe everything off your credit report. And once that happens, then you're able to go, your credit score will increase, and then you're able to go get that loan for that business, or you're able to get that new home that you've been looking at, or go and, get that new car. But what was sad is I didn't even understand the process of credit repair. Even the people that were helping me they didn't understand the process because they began to wipe away all of my history on my credit report. And so, yeah, at one point my credit score increased 120 something points, but in 3 months later, it went back down lower than what it was before I started into the credit repair program. And then I began to build my credit. So we all have these people that tell us, get a secured credit card. And these are things that are true that can help you, get a secured credit card, add yourself as an authorized user to these different like your spouse or your mom or your dad or your sister, somebody's credit card that knows how to handle and manage a credit card. Begin to add yourself onto these things. Go get a loan, a small loan from your bank and start. And all of these things were great. But they didn't propel my credit score. They didn't help me increase my credit score. They didn't help me boost. I mean, I would see maybe some points increase here or there until I had to really look at my credit report in myself, my habit, and I had to realize that I needed to take care of my debt. I had to take care of my debt. I had to distinguish between good debt and bad debt, and I had to take care of it. And so I began to, look at my credit report and see what the first thing I noticed was my car loan was extremely high. So I began to make double payments on my car note. I began to take, knock that debt down. And when I began to knock debt down, that increased my credit score tremendously. So then I began to learn that, okay, it's not just cleaning up my credit report that works with credit restoration. I also have to take care of some debt. Like Crystal said earlier, you have to be accountable. And so I had to be accountable for my debt and I had to take care of it. So I had to begin to take care of a major part of my credit report was my own current debt, regardless if it didn't have any late payments attached to it. That was a large amount of money that I was dealing with. So I began to make double payments on my car loan. I had to pay down credit cards. I had got loans that were not reporting to the credit bureaus every 30 days like they told me they were. So I had to remove that stuff out the way. And once I began to remove that stuff out the way, it allowed me to open up the doors to that American dream. I was able to purchase that home that I wanted to purchase. And notice I said that I wanted to purchase because I wasn't limited. And that's one thing that I can tell you that when I got my credit together, yeah, I was able to, go buy a car and get a home and start these different business adventures. But I also was able to change my mindset. And sometimes that is the biggest thing in helping you create wealth is your mindset. Because I want you to sit where you're at today and ask yourself, how many times have you told a friend in the last 30 days that you can't do it because you don't have the money? How many times have you told your children no because y'all don't have the money? Now, there's a difference between you investing in something and just don't have the money, but literally don't have the money. And so whenever I began to get my credit taken care of, then I was able to change my mindset a little bit and start thinking outside the box. And then I was able to dominate my finances because that's all wealth is dominating your finances. You don't allow your finances to dominate you. If you can't go because you don't have the money, then your finances controls everything you do. That means your finances is going to control you purchasing a home. Your finances are going to control you starting that business. Your finances is going to control your wealth. Your finances is going to control everything that you do when you were there to create the wealth. You was there to create your, to dominate your own finances. So whenever I began to take care of my credit, that was a huge thing that came to me was that mindset change. And then after I got my credit score where I needed it to be, not where people were telling me, oh, you just need this credit score and you can get into this home. No, that's not what I wanted. I wanted to get into what I wanted because I worked hard for that. And so when I got the home, it opened up opportunities for me to open a business or even expand my business. My husband is a truck driver. He's been driving trucks for over 6 years. So when you start getting your credit taken care of, you start looking at ways to where you can save money, right? So we started looking at, if we get our own truck instead of leasing a truck, then that's money that's coming into our home. That's money that's taking care of us. and we're not just getting a small piece of the pie, we're getting a bigger portion of the pie. And then we started looking at dispatching. So now we can start, I can start dispatching. I'm at home. So that income that you paying, $45,000 somebody's salary for dispatching, that can be my income. That could, now we started creating jobs and really building wealth, not just for our family, but other people, other families. But you have to start with your credit, and you have to learn how to dominate your credit, and manage it, because it's pointless if you don't know how to manage and dominate your credit. And you're going to always have debt, but there's a difference between good debt and bad debt. And my golden rule every time in regards to debt is, I tell people, how is that going to circulate money back to you? My house, this is something I wanted, but I operate many businesses out of my home. I had purchased a new vehicle back in July. It was my dream car that I wanted, but guess what? That is a marketing tool for me, because people they know my story, and they like, wow, she went from a 2011 Chevy Impala to now she's driving a Mercedes with no money down. That's because my credit, I went in there with power and told them, this is what I'm going to do. So I'm just going to give some tips. Crystal told me to be myself. So I hope that you all came with a pen and a piece of paper, because I'm going to give you tips for you to look at. So when we get off of this live, you can go and look at your credit and see where you need help. I've also put my information in the chat box. So if you have any questions or concerns, you can definitely reach out to me. But one thing that people do not understand is how your credit score is calculated. A lot of people say, well, if I pay my bills on time, or if I put my rent on my credit report, that'll boost my credit score. And all of that stuff is great. But you need something, especially if you're wanting to be a business owner, you're needing funding for your business, then you're wanting to do something that's beyond that. That's general information, right? For beginners. And so one thing that you have to look at is you need to go and look on your credit report and see what items you have that have the longest history, right? You need to look at that history. So just because you have a student loan that you feel like you will never be able to pay off, and it has all these late payments attached to it, instead of removing that from your credit report, ask them to update it. Tell them that you've never been late, especially if some of you have got like deferred payments or got into some of these student loan programs. Now your student loans are reporting positive, right? So if there's any late payments attached to them, just write a letter stating, hey, I once was late, a few times, but I'm current now. Or you can be slick with it and just tell them, I've never been late, because the credit bureaus really do not know. When you're disputing things with the credit bureau, it's basically our story against the collectors. That's it. We're just proving that we are correct. And so you want to make sure that you want to clear them late payments up. You don't want to erase that from your credit report. That's why a lot of people say, oh, I paid my car off early and my credit score decreased 43 points. Yeah, you just closed a whole 4 years of history on your credit report, and you needed that. So that's what it means by payment history. And then paying your bills on time. Paying your bills on time does not necessarily mean your utility bills or even your rent. It means your credit cards, your installment loans, things like that report every 30 days. That's what you want to pay on time, because that's what the lenders are going to see. Now, if you don't pay your rent and you get evicted, yeah, of course, that's going to go on your credit report. But what I'm talking about now is things that come every 30 days and that actively report on your credit report, not because you defaulted on it. And then the next thing you want to look at is the amount owed. I have a lot of people that do not understand this. So I'm going to say this real slow because I know I can talk fast, but I'm going to say this as slow as I can. Credit cards are 65% of your score. So if you do not have any type of credit card on your credit report right now, you are damaging your score anywhere between 40 and 150 points, because 65% of your score is based off of your credit card payments and your credit card usage. And if you do not have that, you are hurting yourself. So some of you are probably saying, you know, I have a low credit score. I can't get approved for a credit card. There are credit cards out there that will approve you to help you build your score. And so, and I will actually share some of this information with Crystal so she can post it on her website so y'all will have it. But you want to make sure that you have your credit card, and I'm pretty sure all of you know that you want to keep your credit card under 30% usage. That's great and all, but to have excellent credit in the world that we live in, you want to keep your credit usage at 15%. And so this is the trick, because everybody wants to have a credit repair trick, and this is the trick. Look on your statement that is due, and you will have two dates. One will be the date that it's due, and then one will be a date that it closed. The closing date is the most important date out of these two. For instance, my credit card closes on the 8th. It reports to the credit bureaus on the 12th. So what I do is I make my payment on the 8th, and you can make the minimum payment or you can pay over. It really doesn't matter. It's your preference. But on the 12th, if I have a credit card that has a $200 credit limit and I know I've spent $190 on that credit card, by the 12th, I'm going to pay that $190 off, or at least $180. The new algorithm now, if you pay it to a zero balance, then it'll detect like you don't use the card, and so that could ding you too. So you at least want to keep $5 to $10 on your credit card. But I would pay that before the 12th. I actually pay it on the 11th. And the reason why I do that is because I have $190 on this credit card. The credit limit was $200. That puts that credit card usage at 95%. And if I'm trying to build my score and I just got to a 620, guess what? I could easily go back down to a 520 or underneath 520. So you want to make sure that you know your closing date, and you know of course, your due date to your credit cards. For my business owners or people that's wanting to get into business, getting these secure credit cards for $200, all of that is great. But let's be real with each other. $200 will only take care of our LLC, right? It's not going to help us launch our business. It's not even going to help us operate our business for 30 days. So many of us may get a tax refund, or we've saved some money up. Take that money and put it in a secured credit card to where you can have $2,000 to $3,000 to work with. Because, we get upset because we say, oh, they denied us, but you don't have nothing on your credit report that shows that you can operate or manage over $1,000. And that was one thing that a lender had to come and tell me when I went to do my, when I went to go apply for my investment property. One thing that the lender told me that helped me, my husband and I, was that we had a home. So we had a mortgage loan, and then also we had, my husband's truck. And so these were large purchases, and that we were able to keep up the monthly payments on it. So sometimes we look at the balance, and it's not necessarily the balance that the lenders are looking at. They're actually looking at how you manage the payments, how well you keep up with the payments, especially during a pandemic like right now. A lot of people, it's tough for them, and that's what lenders want to know. It's just that we're at high risk if we have these late payments, or if we're stealing from Paul to pay Peter and all this kind of stuff. Like the tax profession just said prior to me, you just want to make sure that you have a clean slate, like everything is crisp and clean. And it starts with your credit, with your debt. So I encourage all of you to go and, look at your credit report. If you're not monitoring your credit, shame on you. But you want to, there's some great apps for you to look at. I always encourage people to do My FICO. Especially if you're looking to purchase a home. That's going to be a little bit more accurate for you in regards to what lenders see. Now, we will never be exact as lenders because their pointing system is totally different than ours. So for instance, if we have a 650 credit score, Experian will say that your credit score is fair. But with the lender, your credit score may just be average. And so that's why you have that difference when you go to a lender and you're like, well, Credit Karma said I had a 700 and you're saying I had a 400. That's why. So if you want something a little bit more accurate, I do encourage you to subscribe to my FICO. And then another one that I use is Experian, because they have a little bit more accurate information for you as well. But you want to go and look at your credit report and see what's on there that you can clean up or that you can have them to correct. And then student loans. Student loans is an excellent debt to have on your credit report because many of us have student loans and they're over $20,000, right? So just make the payment. Because even though it's going to take you probably to your kids graduate and your grandkids get here to pay the whole thing off, they're not looking at the balance. They're looking at how well you manage and take care of that debt. That's it. They're not looking at, oh, how soon they're going to pay this off. Now, it could play a huge part into okay, so your debt to, if you're trying to purchase a home, it may say, the lender may come back and say your debt to income ratio is too high. But that's why you begin to look and see what you need to pay off, what needs to be taken care of. Like I said, I doubled up on my car loan just so I could get the best interest rate that I wanted. So, just to refresh with you on what you need to look at on your credit report is you have to have use of credit. You have to have some type of credit card on there on your credit report, because that is a huge, huge, huge factor to your credit score. And then you have to make sure that you make them payments on times, but you want to keep that payment history with them accounts. So don't just go and start wiping stuff off your credit report because it looks negative. Because some of us was probably a mess at one point, and now we all have a message. And I'm talking to myself. I may not be talking to anybody else, but I'm talking to myself because finances was my poorest subject in life. And now I'm educating people all across the US about finances and credit. So you want to make sure that you can clean that history up first before you automatically remove it from your credit report. And then you also want to have a mixture of credits, because it's like, if picture yourself at a circus and you're juggling all this debt. That's what lenders look at. They look to see how well you can take care of your car loan and your mortgage loan and a personal loan and your credit cards and your student loans. They look at all of that stuff. And if you're able to manage all of that stuff, you're a great candidate for that home. You're a great candidate for that business loan. So a lot of us have great ideas to start a business, but we miss the key factor in that business is our credit, our finances. So I can ramble all day about credit. So I don't know if Crystal is wanting to do questions now. If you have any questions, or you have some information or have some questions in regards to your own credit, I will definitely be able to answer them and get you taken care of.
Tasha, that was so, so good. Thank you so much. I mean, those
You're
nuggets
welcome.
are like, that's what we needed to hear. And
Right.
so many people don't understand the importance of building your wealth requires for your credit to be a certain way. And everything that you just spoke about is something that I just recently went into in the last 3 months, because I just purchased a home, and
Right.
they were checking my student loans. They were checking, and I owe a lot, but they just so happened to disappear long enough for me to get a home. Because if it wasn't for that, I'd still be homeless, or I would not be a homeowner, and I would still be renting. But I mean, even with the Credit Karma, I was thinking my credit score was like a 680, almost 700. And the bitter reality of it was not. It was more like 600 in the middle score.
Right.
And then my high
Right.
score was 640. And I was like, why is this so drastically different? And they were like, it just depends on the lender that you go through and what they're looking for.
Mm-hmm.
And they literally have their own point system. So I'm going to open it up. If anybody has any questions, we're going to take like 4 minutes of questions before we move on. Anyone?
Ask now. Don't be shamed. We all done had credit credit challenges. Trust me. I had 13 maxed out credit cards, student loan debt, all of that. So
Is filing a bankruptcy good or a bad idea? That's a
I'm
good one.
against I'm against bankruptcy. And the only reason why I am against bankruptcy is because it doesn't change the habit. So what I encourage people to do first is work hard on your credit for 1 to 2 years, especially if you're not like trying to save a house or a car or anything like that. Work on your credit, give it 12 months, 24 months, and then if you don't have anything, then you go and give yourself the death sentence, because bankruptcy is literally it's a death sentence to me, because you pay all of this money. Like, I have a client that paid tons of money every month, and you could have invested that money into your debt. Why give it to a bankruptcy attorney when you could just pay the debt off, when you could have just Googled a letter, told that collection, hey, I'm going to pay this in full, can you please, remove it off my credit report? And once you did that, then it'd be taken care of. And I can tell what road you're on, because that was my next thing. Do not, please do not do debt consolidation. And this is why. You have a Capital One card. The card is $1,000, and you're making $250 payment towards all these other debts. Just keep in mind, this Capital One is just one debt that you have. And so you're paying $250 on all of these for them to disperse amount of money between, say you got 5 other debts that you have consolidated, but Capital One is the one we're going to focus on. So you're paying $250 all these months, and then all of a sudden you don't uphold your end of the contract with them, but you've paid enough to pay Capital One off. It's still stuck on your credit report. And you just then paid them all this money. Now you got to jump through hoops to get information from them to prove that they didn't pay Capital One off. So I am so against debt consolidation. Just get yourself in gear, pull your credit report, look and see what needs to be taken care of on your credit report. And I am so against debt consolidation and bankruptcy, because that money that you invested, you can basically send that to the collector and write a letter and negotiate with them. They're not bad people. That's what we think, they're bad people. They honestly are not bad people. They will work with you, especially if you have money to pay your debt off. Garnishment, all I can tell you for garnishment is don't run from it. If you get, because people don't understand that there's a process to garnishment. So they have to reach out to you several times. And like I had said earlier, when you go to these financial institutions, they don't know that you've had a death in your family. They don't know that you've lost a job. They don't know that, all of these things have happened. But when you have a garnishment and you have to go to court, you have the opportunity to tell your story. You have the opportunity to let them know that this is what happened and this is why I couldn't make my payments. But prior to this, I was making my payments on time. I was doing this. So don't run from it, because when you run from it, you give them no other choice but to take the money from you. And you do have the right to negotiate with them. Like, just because they say they're going to take X amount of dollars from you doesn't necessarily mean that that's what they're obligated to take or that's what they're going to take. But if you ignore it, then it will be a nightmare in the end. So that's what I say about garnishment.
Wow, that is so much helpful information. I'm going to put your contact information on the screen. Thank you again, Miss Tasha.
You're
That was
welcome. Thank you for
amazing.
having me.
Her
I think
contact
somebody had one more
information.
question.
Yes, I believe there was one more, or a comment, I believe, more of the such. So you can reach Latasha at 405-788-6025, or go to her website, which is on the screen. You can also reach her from her email, and she is on Facebook and all other platforms. Just look for Tasha Stewart. And
Thank you,
again,
Crystal.
thank you for coming today. That was so amazing. So, you guys, like I said, we want to grow your wealth. So, we're going to give our cash giveaways at the end. You'll either receive it by PayPal or Cash App today. So, we want you to go to giveaway WHOWnetwork.org/win, WHOW network.org/win. Okay, so moving right along, something else that is very, very important is paying off your home early. And imagine what you could do if you didn't have to worry about a mortgage payment every month. With a paid for house, you could literally build some momentum and accomplish your financial goals even faster. But even more importantly, what about if you just want to purchase a home to use as an asset? Because having a home really can help you to build your wealth if you're ready to build a home. So our lovely Miss Azure D. Sade with real estate, she's a real estate and financial stylist. Azure D, are you there?
I'm here. Hello, everybody. How are you?
Great. Thank you for joining us today. I know that today is a special day for you, so I really appreciate you taking out your time today and being with us and helping us. So, if you could just dive right in and tell us about the importance of growing your wealth through home ownership.
All right. Well, hey, I'm going to introduce myself. My name is Azure Sade. I am a real estate broker, real estate educator. I own the school Realty Stylist Academy. I'm also a commercial loan broker where I help small business owners get the finance they need creatively, whether it's hard money to begin to invest in real estate, or if you know they're a seasoned entrepreneur and they need financing for equipment for their current business. My goal is to allow them the growth, the capital to be able to sustain their business, to not only go from ideation to concept, from ideation to concept to but even further to sustainability. So as you know, Crystal said, I am a real estate professional by trade. All things real estate I'm a part of, whether it's one, helping you find the house, two, finding the financing, whether it's through traditional mortgage or getting finance through brokerages and investors. I'm your girl. So without further ado, we're talking about home ownership and the advantages of home ownership. And I'd like to take a step back to tell you, one, the disadvantages of home ownership, because there's two things, and I think we can't have one without the other. I'm an educator, and I always like, if I'm told to speak on a topic, I want to make sure I'm giving as in the 15 minutes that we have, I want to make sure that I'm giving a well-rounded, giving you well-rounded information, and at least the ability to understand why it's important to, one, be ready to own a home, how to get ready to own a home, okay? And the advantages of both renting and, well, owning. All right, so I'll say the first step to why you should be, one, if you always had an idea of owning a home, you know, maybe you never own, maybe it's maybe you've never owned a home, you want to own a home. I think the first step you should be thinking about is, where is your financial? I love that we're talking about wealth. I love that we're talking about the steps to wealth building. I love the information that Tasha had just given you guys about credit, so I don't have to go through that at all. I actually work with Tasha on a lot of my personal credit client, for my first personal credit client. So she's my go-to referral for all of those needs. So I'm happy to share the platform with you guys. But to talk about wealth and why it's important for home ownership, one is, when we look at our counterparts, when we look at wealth in America in general, most of the wealth is held through real estate. All right. So if we look at it, about 44% of individuals' wealth, I can look at any portfolio, and many of the financial advisors here on this platform today can tell you they can look at any given portfolio and they're going to see that investor have some shares, some portion of their portfolio in real estate. Okay, so that's the one. It outperforms, real estate outperforms the stock market 9-1. Okay, always, it's consistent and it's scarce. They're not making any more real estate. Okay, all the real estate that's made, it's already been made. They can't invent it anymore. It is a commodity. Land is always a commodity. So when you think about why real estate is important, right, is because if we take two poor individuals, all right, same platform, poor, okay, and I can talk because my background, I tell people every time, many of you have heard it before, baby, I grew up okay, straight couldn't afford the R, all right, just that serious. I just couldn't afford the R. So I know what it's like to be poor and work your way up the climb the ladder, pull yourself up by the bootstraps. So these are some tips that you're going to have to undergo, and you're going to have to follow. So first thing first, why is credit important? Because if you look at wealth, back to my point, if you look at wealth, we're talking about two poor individuals based off national standards, right? We're looking at two poor individuals, and we could even go to the extent of saying black versus white. All right, two 100% poor as far as income is the income requirement, okay, and the gross income. All right, looking at both of them, the individual, whether black or white, that owns property, whether it's land, trailer, whatever, you own the property, you have more. Even if that person has same poor as far as income, the one who owns land has more wealth, or far wealthier, and we're talking 40 times wealthier than the individual that's poor without real estate at all. All right, this is important because even if you're purchasing just land, we're not talking about just housing. We're not talking about houses. We're not talking about multiplex yet. We haven't even got into that. We're just saying you acquiring land. Why? Because land holds value. Why? Because I just mentioned before, all the land that's here is all the land that you need to make money on is already here. We can't magically make any more land. All right. Similar to, as in stocks, they can split stocks. They can create more stocks. They can manipulate that. You can't do that in real estate. All right. So it's pretty steady. And most people, if you don't want to be out on the street, right, you're going to need some form of shelter, some place to live. So that's why owning real estate is important. Even if it's just land, just raw land, you are far more wealthier on the scale than an individual who doesn't, right? All right. As far as portfolio, and I'll tell you that because if you go to the bank appraises the land is worth $40,000. Let's say you pay $50 for it. The bank assesses the land and the land is worth $40,000. You can now get a loan for the land to build on that land a house or whatever. Why? Because you own the land and that land holds value. All right. So does that make sense for everybody? I just want to make sure I'm not talking to myself. Can you hear me? Crystal, how are they responding? All right, everyone, you can hear me. Great. The second thing is owning, all right, Erica, I hear you. Tasha, you hear me. Okay, great. All right, the second thing is owning land. Okay, so what makes you, I think the question, in this short period of time, because I love real estate and I can talk all things real estate all the time, okay? Sometimes they have to say, like, slow down, and I only have 15 minutes. So the next reason why it's important to have real estate as an investment, I tell my clients all the time, if you're looking to purchase a home and the home is, let's say, well, one, before you're thinking about investing in a home or even purchasing a home. And again, I'm a real estate professional. I buy, sell, and invest in real estate. I help others buy and sell their first home or their, second home or whatever. I help them that, and I would love to earn your business, but that's not what I'm going to tell you is going to be a little, you're going to be like, well, what do you mean? I mean, I'm in the business of selling homes, right? But the question is, when should you be looking to purchase a home? And I'm going to say this is the main reason. There's 5 stages of wealth. I like to call them stage 1. I'm going to go through these really fast, and hopefully you're following along with me. The first stage is you need to assess your temperament as a investor, as a homeowner. Okay, what is your temperament? This is what all investors, and when you're looking at investing in general, no matter what field it's in, how you look at it, you need to assess these 5 growth stages, and it'll help you identify what type of person you are and what type of investor you're going to be and where you're at in the process. All right. So the first stage I have is, I like to call it the survival stage. All right. And if this is you, just take mental note, write it down. Hopefully you have a pen and paper where you're able to write this information down, and it gives you a lot of introspect or to look at yourself and say, well, this is where I am. This is where I need to be. It's not to make you feel bad in any type of way, but I'm really here. I think we have this time on this platform to allow you to really get an idea of where you are so that we can really create a solid plan. You have amazing speakers on this platform, so we want to make sure that you have the foundation. So I'm going to give you these 5 steps. The first step is survival. Are you at survival? Do you need a job? Is it, because I know we have a lot of entrepreneurs here, a lot of self-empowerment, and, I'm a little different. I'm a little rough around the edges, not to mention, but are you at stage 1? And that's survival. You need to maintain a job. If that's you, this would mean, if you're at survival, that means you need to maintain a job. You cannot leave today, tomorrow, and your bills are barely being paid. You don't have enough surplus. You don't have an emergency account. You need a job to keep a roof over your head, your kids, your children's head. You need a job. All right. And that's not a bad thing. All right. But if you're at survival, there's some important fundamental steps that you will need to do. One is establish I call it a put in and put out account, a checkings account, a savings account, something that is going to continually, that you're going to be putting money aside in. It's going to be an emergency account. All right. It can be an account where you are literally trying to save an emergency fund. Okay. You're trying to make sure you're establishing good habits. All right. You know that the rent is paid is going to come out of that account. You know that your car note is going to come out of that account. If you're at a survival stage, you need to get a rein on what's coming in and out. You need to know that every dollar in your household is accounted for. All right. Listen, I tell my clients all the time through consultations. All right. I want to know where my money going. Okay. I work too hard for you to get away and me not to know where you at. Okay. I want to know where I tell my money where to go. Okay. And so if you're at survival stage, you need to fine tune and get into where are you and where every single dime of your money, your hard-earned money, is going. All right. Once you've established that, I call stage 2. All right. It's stability. All right. Now so in stage 1, you're saving up, you know where your money is going. You have that checkings account. Stability. Stage 2 is stability. Now you are a little bit more stable. All right. You know that after your paychecks, you may have $200 left every month. All right. You are in a habit. You are creating a system. All right. Where everything is paid off, where you know where everything is going. You can literally see another $100 to $200 in your account every month because you have identified, you've literally told your money where to go. And that is power, people, women. I want you to know, I know I have some men on this line, but I want you to know that if you can tell your money where to go, you have ultimate power. If you get to the end of the month and you're like, well, where is my money? I don't know where I got paid $3,000 this month and I only got 20. I don't even know where my money going. Listen, that's a problem. You're still in survival. All right. To move to stage 2, you have to be stable. You have to know where your money is going, right? You have to know how much money you have to invest in the next few stages. All right. If you know in stability, you know that everything is paid on time. You know that what's coming in, what's coming out. You know that you have $200 to $300 to invest, all right, to start doing differently. That is stability stage, all right. You know where your money is going. And again, once you've done that, I said stage 3. Now you have $200, right? You want to try to get that $200 in some type of savings account. I know we have Leslie here, we have Camille, we have a lot of people in, the industry. I need for you guys to talk to someone in that profession to get you some type of mutual account, some type of investment account where it's safe. It's not as risky. Okay. So you're taking that $200 that you saved, right, in survival. You're now stable. You can see that you have this extra residual income coming in some way. All right. At stability, I didn't mention this, but you're either creating you're looking at, hey, I only have $200. I have a goal of getting to 10K with my business. I need X amount. You need to think about what resourcefulness, what skills you have, how can you make additional income, maybe giving of your time or capitalizing or leveraging your knowledge and skills. This is the stage of stability where you decide how you're going to do that. Stage 3 is saving, using those resourcefulness, those skills that you've learned in your stable growth pattern and deciding to save. Again, getting with Leslie, getting with those guys and getting a mutual fund, getting an IRA account, getting some type of stock that it will give you small incremental earnings. All right. So you're saving. Now you know what that looks like. All right. So hopefully you guys are following me. All right. And then for the 4th stage, I call it the growth. Now you've saved, you know what your account looks like. You're out of survival stage 1. You're heading to stability. You know what additional income that you have coming in. You know that you have you can do certain things, whether that's doing hair, whether that's starting a graphic design business. You know how to make that money grow. All right. Then you're going to talk to a professional, an investment professional, to see how you can get that additional income in some type of incremental savings account, stocks, bond, mutual funds, whatever that looks like. Talk to a professional, get that growing. Once you are at I like to call the saver stage, which you're going to go to growth. Now you're able to talk to somebody and say, hey, now I want to decide, am I a passive? I want to see more growth. All right. Now I'm stable. Now I'm out of survival stage. I am out of stability, stage 2 stability. I am now saving. The 4th stage is growth. I am ready to grow. I am ready to see my money work for me. And this is the stage that I like, this is the stage that I enjoy helping my clients do. At this point, we can determine, well, we're in the survival stage. We're making these incremental steps and we're growing together. You're growing, you're learning yourself, your financial acumen. And at stage 4, we're ready to execute a plan. And this is important for real estate. When you are looking to get into real estate, you need to know that you're stable. And this is why I gave all of these stages. You need to know that you're stable. All right. We don't want to get you into a home and you're not stable. You don't know you're robbing Peter to pay Paul. Bills are behind. You've already at survival stage. You are getting your house in order. You've probably spoken to Tasha at this time. She's told you what to do with your credit. All right. You're using that additional income to fix your credit and get into your saving stage where you've talked to Leslie. All right. And then the growth stage is when you're full on ready to go. All right. We're putting together a plan. And this is when you can say, okay, now I want my money to work for me. Should I rent? Or should I use my first time homeowners program to live? Maybe it's better. I'm a single person. I have properties where I rent them out. Why? Because it's just me. I'm by myself. Why do I need a $1,500 or $2,000 mortgage when it's just me? There's no one else. So an apartment where I pay half or even a portion of that will suffice for me, because my wealth goal says that I want a certain amount of wealth at the age of 25 or at the age of 35. All right. So this is a strategy that I use. I would rather use my first time homeowner. I would get an apartment, right? Because my wealth strategy, my wealth mindset is different. I'll live in an apartment. I'll rent my home out with my first time homeowner's voucher. I'll rent it out to a family of 3. They're paying me $2,000 a month. That $2,000 a month not only covers my $1,000 mortgage, but it covers all of my rent for my house that I'm renting. All right. And I have change. I have what? $500 left to do whatever I want with it. So again, if you're thinking about wealth, what is your wealth strategy? Do you want to Airbnb your home for wealth? That's what you can do when you own a home. All right. But you also can do this as a renter. Again, what is your wealth strategy? I'm in real estate. Like I said, I would love to earn your business, but I also want you to be financial, to understand and identify yourself and what stage you're in and what financial risk can you take? Okay, guys, hope I'm making sense to you guys. I don't like to give cookie cutter messages. I want to make sure that you understand what this means. Like Tasha said, that's freedom. Exactly. It's freedom. When you can get up and you can say, listen, I know that I'm stable. I know that I have passed the survival stage, stability stage. I'm at growth. Now I can decide, I can reach out to Azure D, reach out to Tasha and say, hey, how do I make my money work for me? You can decide at that point, you can decide, well, hey, do I want to be a passive investor? Again, these are just things to think about. I can't go into everything that I have in 15 minutes, and I'm probably over the time, but you got at the growth stage, you can decide, hey, am I wanting to be a passive investor where I'm investing in REITs, real estate investment trusts? So let's talk about this. You don't have to invest in physical property where you have to manage it. You can invest in stocks, all right, and share and bonds where you're investing in hospitals. You're investing with COVID. Hospitals shares are rising. All right. They're making money. I have several REITs account where nursing homes are making so much money. It went from $35 a share to now I'm almost at $120. Okay. With investing in real estate, but not where I have to be managing it and I have to do all of that. No, I get dividends paid out to me every quarter. Why? Because I believe in real estate, and real estate, you can be just as passive as you want, or you can be like myself. And I know Tasha's doing this, where you can be aggressive, where you can be involved in the flips, but you have to understand yourself. And I want, if you have to understand you have to understand your risk adversity. You have to be able to get out of dream and concept. Because if it's just in your mind, you're the only one knowing it, and you're not reaching out to the professionals that are out here able to help you, you're never going to go from ideation, concept, and a concept to reality, concept to real estate. So again, what to wealth. All right. Because everybody wants to be wealthy. Okay. No, I've not met anybody that said, well, I want to be poor. I want to be poor always. I want to be just good enough. It's good for me. I've very rarely, I don't think I've ever met one. I think I made one, but that talked the talk, but when it came down to it, they wanted to secure something for themselves and a legacy that would outlive them. And most times that requires wealth. All right. So in any event, guys, I think I have one more in income. So as far as, the fifth stage is income. Once you're at growth, you need to have a strategy that help you determine what's your ultimate goal, what's your ultimate income tolerance, and where do you want to be? Where do you want to be? But those are the 5 steps. Stage 1, again, is survival. Where are you? Are you at the survival stage? If you're just tuning in, if you're catching it on the replay, make sure you go over those steps to help you identify where is your wealth tolerance. Where are you? And how many steps? Where are you in the steps, and how far do you have to go to reach your goal? All right. So step 1 is survival. Step 2 is stability. Step 3 is saving, beginning to save. Step 4 is growth. How do you want to see your money grow? How do you want to see it work for you? Active or passive? All right. And then the fifth stage is income. What is the income potential of the investment that you decided to go with? And thinking that out, so yeah, when you're looking at real estate, you need to understand who you are, identify with yourself. What are you willing to do? All right. How are you willing to address some of the things that you consistently do habitually that keeps you in a impoverished state of mind? And notice I said impoverished state of mind, because I'm a firm believer that wealth is not so much, what you have in your pocket. All right. It's what you have in your mind. If you have the ability to press forward and apply some of the principles that we've shared here today on this platform, I think you're well on your way. Again, wealth is not determined by how much money you have in your pocket, okay? But it's what you have in your mind. Guys, I'm going to open up the floor for any questions. And Crystal, it's all yours.
Oh my goodness, Azadine. I thank you first and foremost, because that is exactly what everyone needed to hear. That was exactly what we wanted to relay the message that, man, those 5 steps, those are all things, believe it or not, I had to go through. And at one point, I thought I was ready to own a home, but I wasn't, because I hadn't built that nest egg, because my credit wasn't together, because I wasn't stable. And it looked like I was together because I could pay rent. I was doing that, but I was robbing Peter to pay Paul. It wasn't until I took a step back, started paying off some stuff that was hindering me, and started putting together a plan and becoming stable, that I was even ready for a home ownership. And then once you're ready, it's maintaining. A lot of people think, okay, now I have the house. Now what? I've been bombarded in just the last 2 months with different people wanting me to do all the different things, things that I never thought about as far as home ownership. Making sure that you have someone to do your lawn, and making sure that you have someone to extinguish and make sure you don't have bugs or rodents. I learned some important things yesterday about a post that was next to my house that could cause termites. It wasn't even the fact of them. So there are so many things that are tied to owning your home or building your wealth, but you have to look at all the costs that could possibly come up to even be ready. So thank you today for coming, going through those stages. There are some people, is that a class that they can
It
get
is
this
actually,
information?
actually it is every
Yes.
Tuesday night, guys. I am on. You can find me at Azure D. Sade, the Realty Stylist, every Tuesday night. You can literally log on and get the information. I am having a class coming up, so tune in, follow my page, add me as a friend. You'll definitely get that information to get started. But I think that you are a prime example of why I'm in real estate and why I do what I do, because I tell people I make the impossible possible. Okay.
Yes.
I help people when buyers can't buy and sellers can't sell. You definitely, went through the whole, one day you have to tell your story, but going through
Yes.
the process, really weighing through all of those things and being ready, not just, some people are ready financially, but not mentally, all of the things that it takes. So now your ownership, you have to switch mindset from just being a renter and owning. And last but not least, I'll say that having ownership, one of the best things I think about ownership is it creates stability for a family unit. You're there, that you have the school district that you want, you can raise your children in a specific location that you've decided. Where you're renting, it's year after year, you don't know. You don't know what that looks like. But I think you're a prime example of what success looks like, of what hacking through, and really fighting and just being a warrior, and
Yes.
staying committed to, I am on the wealthy track. I think you've even created a network like this so that you can gather and galvanize other wealthy mindset individuals and help and empower them. So I think this is the platform for sure to get situated, to get started, and to grow for sure.
I love it. I'm going to put Azadee's contact information on the screen so that everybody can see it and reach out to her. Thank you again, Azadee, especially today. Let's see. There it is. So you can reach her by email, realtystylist@gmail.com, or you can go to Facebook /Azar Sade. And she has several tools and tips on her page. She's a part of BWBO, which is Black Women Business Owners of America. You can look for that on Facebook. There's so many ways that you can reach her, but it starts with having the desire to change. And once you have that, then you're ready. That's the biggest step, is wanting the change. And then once you want the change, letting WOW and some of these other organizations get you to the resources so that you can sustain those changes. Again, you guys, the giveaway to enter to win is wownetwork.org/win. And we're going to get into the fourth step of building wealth, which is investing. And they say 15% of your income for retirement is the sweet spot. But there is a plethora of other ways that you can invest. But being debt free and having money in the bank to cover emergencies gives you foundation you need to start saving for retirement. If you start with saving 15% of your gross income, you are well on your way. So I have the wonderful Miss Camille Diaz, which is the lead manifester, and she is here to talk with us today. Miss Camille, are you there?
I am. Thank you, Crystal.
You are
So
so welcome.
Yeah, so happy to be here and grateful to share with you. Really enjoying all of the information that's been coming from all of the speakers today. Just such helpful information to help everyone get on a fabulous financial track. What I'm going to share is something that I kind of feel like is a little bit of a financial secret. It's something that most people don't know about. So I want to make sure that we're getting the word out about options for how people can grow their wealth if they choose to do so. So I'm going to go ahead and share my screen. I'm also dropping my contact information in the chat before I forget, because I will typically forget. And I want to kind of show a little bit of this information, and then I'm actually going to get into a little bit of exactly what Azure D was talking about at the end, and thinking about those stages of wealth. So I love that we've got such great information coming out from everyone today. One of the things we talk about when we start chatting with people about finances is this financial seesaw, a way for saving. So when they're thinking about their retirement savings, a lot of people are conditioned to think about it as two things. One is risk and one is safety. And they only think about those two sides. So on the risky side, we typically have things like 401k, IRA, stock market, mutual funds, commodities like gold and silver, and sometimes real estate, because everybody remembers when that thing happened in the market and it was a little tad bit risky. What we love about the risky side is it has really big potential for gain. What we're not so crazy about on the risky side is sometimes it has really big potential for loss. Over on the safety side, we have things like CDs, money market accounts, savings accounts, bonds, and under the mattress. And at first, we just put that in there to kind of add some levity, because sometimes financial stuff gets to be a little boring or makes people a little nervous to chat about. But then what we kept hearing from people is they would come to us and say, actually, I have $10,000 under my mattress, or they've got money in the backyard, in the freezer, in the attic, in the garage, all these places, because they're nervous about having some money where they can get to it, touch it, see it, know that it's there. So what we like about the safety side is it has very little potential for loss. We're not so crazy about on the safety side, very little potential for gain. So if we go back in history a little bit to some of the most tumultuous years in the market, and in fact, if we look back even further to the early 80s, only about 15% of Americans had money invested in the market. You had to have somebody to go do it for you. You couldn't do it on your own. There was no jump online and day trade in your pajamas type of thing. And there was a minimum buy-in. So if you didn't have enough money, you couldn't even get started. Around that same time, they came out with this thing called the 401k. There's a little loophole in the tax code, and people figured, well, if we put money into the market through our 401k, we would save on taxes now, and then the market's going up and up like crazy. So we're going to retire and go get a beach house or a mountain lodge or both or whatever we want. It's going to be amazing. What ended up happening is by the year 2000, about 71% of Americans had money in the market in some form or the other. Usually it was inside their 401k. What happened was the companies transferred the responsibility of retirement from the company and the pension system over to the employee through the 401k system. So 2000, everything was going along really great. And then the next thing you know, we had 2001. 9/11 happened, the dot-com bubble burst, and a lot of us had an opportunity to lose almost half, or about 42% of our savings. And at this, I knew a lady who had all of her money invested in tech stocks, and she lost like 80%. Basically started over. What's interesting is at this point, many experts said, don't worry, this is an anomaly. It will never, ever, ever happen again. You're fine. So people just kept trucking along. They figured at some point they'd make up for the loss. And in fact, by the time we got to 2008, we were about 4% above where we were back over here before 2001 happened. Okay. In 2008, we had another opportunity to lose about half of our retirement savings. And in this time was actually more, it was a 54% correction in the market. And that was when people stopped saying never and they started saying when. When might this happen again? And people were so nervous that a lot of them actually took their money out of the risky side, threw it over into the safety side, parked it in a money market account, and left it there earning 0.5% or less for like the whole rest of the time. And then they missed all of the upside that came after that. When we ask people if they could wave a magic wand and choose anywhere they wanted to be on this sort of financial seesaw, most people say, I would like to be right here in the middle. When the market goes up, I want up. But when the market goes down, no, thank you. And then they kind of laugh and they say, yeah, but I know that doesn't exist. So the reason I'm teaching this is because it's one of those things that is not often taught. These things have been around since 1995, and they're called indexed accounts. So let's kind of go over how an indexed account works. I do not have time to get into all of it, but here are the basics. We take the money and we look at an index. So let's say the S&P 500, whatever index it happens to be, but we'll just do that as an example. We look at the index, but the money is not actually in the index. It's not actually in the market. It sits in a bucket on the sidelines, and we put that bucket in a very secure shed in my backyard. Okay, I know, cheesy jokes. We don't do that. We actually place it with an insurance company. And a lot of people say, well, why would you do that instead of placing it with a bank? My grandparents went to the bank. Bank's great. Well, do you remember what happened to over 400 banks in 2008, 2009? Yeah, a lot of them went under. Okay, these big insurance companies did not have that same problem. Other thing about insurance companies is they work on guarantees. They're not doing speculation, they're making guarantees. And so they can guarantee certain things about the account. So if you had your money in this bucket and you're thinking, okay, what options are there for my bucket? Well, basically 3 things could happen. It could go up, it could go down, it could go sideways. When I ask most people, well, if you could eliminate any of these arrows, which one would you eliminate? Most people will say, I'd like to eliminate the down arrow. But again, I'm not sure that's possible, but it would be nice. With an indexed account, it is possible. So let's say, for example, that the index goes up 8% the first year. Okay, cool. Well, what happens to your bucket? Exactly what you think should happen, goes up 8%. The next year, let's say that the index goes down 8%. Now, if your money was actually in the index, in the market, then your money would go down 8%. However, remember how I told you these companies can make guarantees. So in an indexed account, there is a guaranteed floor of 0, which means that year, nothing happens to your bucket. It goes sideways. No change. Let's say that the next year, The index recovers big time and it goes up 12%. Well, just like anything else, wherever there's a floor, there's usually a ceiling, okay? Sometimes we jokingly call this the not too good to be true line. So let's say the ceiling was at 10, then that year your bucket would get 10%. Okay, so where you're never having to go down, you're either going up or you're holding and waiting for the next up. These accounts can be done in a lump sum rollover. So somebody could take an existing 401k or an existing amount they have in savings and put it in all at once. They can also be done as a monthly contribution, which is kind of how we're trained to save our money. We contribute to something every month, so they can be done that way as well. They can be used to create something called guaranteed lifetime income. So this means that when you decide to switch on your savings, you want to switch on that retirement income, you say, okay, send me my money. They promise to send you the same amount every year for the rest of your life. So it creates money that you cannot outlive. How many people have heard stories about someone being in their 80s and next thing you know, they're in poverty because they don't have enough money to keep going? It can also be used to create tax-free retirement. So this is knowing the strategy of which program to get into in order to make that money tax-free when it is received in retirement. So it grows tax-deferred and comes back tax-free. It is possible to do that. We teach a class called Money 101. It's got a lot more information than this. This is just a tiny, tiny snippet, and are always happy to talk and discuss and share more information with people because I feel like all of these money secrets should not be a secret. I want to talk about one other thing today. This is the 3 phases of saving. Okay? Your first phase is the protection phase. In the protection phase, this is where you put everything in place so that you know you are covered. This is the foundation of your building. This is how you know you're going to build something solid that is going to last. So here we're talking things like your emergency fund, improving your credit, making sure you have life insurance, preferably with living benefits so that you don't have to die to use it. All of that is part of your protection phase. The next phase is the accumulation phase. That's your growth phase. And you grow in 2 ways. 1, you're making contributions, and 2, the interest that you're earning. So wherever you have it invested, whether you're doing it with real estate, whether you're doing it with an indexed account, if you have money in the market, if you have it somewhere else, if you have a combination of all of those, wherever you're investing it, that's your accumulation phase. That is where you're growing. The last piece is the distribution phase. This is the phase that I see people forget about the most. However, this is the phase that we need to be thinking about when we're doing the protection and the accumulation phases. This is actually the part to build the plan upon. It's figuring out how much money do I need in retirement? How much money do I want in retirement? And when is enough enough? When can I stop saving and switch on that income? When am I good? Okay, what's my number? How do I know? So Stephen Covey says, begin with the end in mind. That's what I want to encourage everyone to do is when you're doing this planning type of thing, get creative. Think about how do I want this to look 20 or 30 years from now? How do I want my future to be? When do I think I might want to start pulling some of that money? Then you can calculate backwards. When I coach people, I call that backtrack to action. You can calculate backwards to figure out, okay, what do I need to do today to get to that in the future? What are my milestones going to be so that I know I'm on track? And then if I'm not on track, how am I going to redirect something to make a change and make sure that I've got it where I want it and that we're back to the plan that I want to be? Okay, that's what I have for you. So I'm going to stop my share and I'm happy to take questions. You can put it in the chat or unmute and let me know what you'd like to chat about.
Thank you so much, Camille. That was very, very informative. So, when people invest, or what is a safe investment that you don't have to go through someone to do?
So whenever you're doing what you call an investment, where you're going to put your money into some kind of an interest-bearing account, you've almost got to go through somebody somewhere. So unless you're just dropping it into your savings account at the bank, which you'd still had to go through the bank to open it, but you could in theory just open it online, you will always have to do something through someone, because most financial products are not where you're just going to go online and do it. And I wouldn't recommend investing in your savings account, because I mean, that percentage is so low. It's like, well, 0.1 or something like that. It's not enough money to really grow in a reasonable amount of time. As far as what I think you might be getting at is, do I have to pay fees, or do I have to share my investment results with somebody? There are multiple ways to do that. There are some people who manage assets and they charge a fee, which is typically a percentage of the client's money that gets paid. Whether the client makes money or not, they still charge that fee. I don't work that way. I actually get a commission from the companies I represent out of their general fund, not the client's money. And I only get paid if I help somebody. So I always see if I have something that's a good fit. If I don't, I don't. And if I do, then I get rewarded for that by the company, but money never comes out of the client's account. All the gains go to the client. So it's a great question to ask when you are looking at some sort of an investment, to say, okay, what am I spending out of my money to potentially gain in this investment? Did I answer your question?
Yes, you did. That's amazing. So what are um so with investing, what do you suggest? Like, what are the steps for people that are over the age of 30? Where should they be starting at? Like, what is the safe investment? And if they did go the route of um, is there a certain amount that they have to have before they can even start investing?
Right. So I would recommend everybody follow those 3 phases, regardless of where you are, whatever. Make sure you have your protection piece first. Make sure you've got your foundation set. Because if you don't have an emergency fund, if you don't have your life insurance done, if you don't have your basic budgeting figured out, if you don't have your credit at least at a manageable phase where you're not struggling and scraping in that desperation phase all the time, everything else isn't going to work. You can't move to the next spot. So that's where I would tell everyone to start. As far as safety goes, I think what you're asking about is the level of risk. So
Yes.
if somebody wants something that is not risky, index accounts do not have risk, because they have that guaranteed floor where you will not lose money. So for sure, at least everything you put in will still be in the account. Nobody can ever promise gains unless you are getting a fixed rate. So kind of keep that in mind. If someone says you're going to get 12% every year, just walk away, because that's not realistic. If somebody says you are getting a fixed rate of 2%, okay, that might be a thing, because you're probably going to commit to leave your money there for a certain amount of time. That's kind of an interesting thing too to think about, is that usually you will gain more if you commit to leaving your money longer. So if you wanted to put it in something where it's liquid and you can go access it anytime you want, then you're probably not going to get the same amount of gain as you would in an account where you agree to leave it for a while. So you can't have liquidity and high gains and no risk all in the same package. That's just not how the financial world works. So you're always going to have to balance all 3 of those things to get the result you want. When people are thinking about risk and thinking about their options, I encourage you to do what is comfortable for you. Some people never want to lose money. I'm one of those people. I hate when I lose money. I feel sick when I lose money, for something that it just does not work for me. So my niche is safety. That's what I focus on. There are some people who are like, put it all on red, let it ride. And they're comfortable with that, which is okay. There's nothing wrong with that as long as you can afford it. So
Yes.
whenever someone wants to do something risky, I say, can you afford the loss? If everything you put into that risky investment, regardless of what the risky investment is, if everything you put in there disappears tomorrow, are you still okay? Or are you going to start throwing up? If it's going to make you sick, it's probably too much for you to risk.
So it really is like doing a gamble. sometimes because you don't know what the market is going to be like. But if you do it wise, then it really can benefit you. I know firsthand of some of the investments that I've invested in. I am glad for those investments because they're more stable, but I'd rather have stable, continued growth than unstable, unpredictable growth. So,
Yes,
but
yes.
if you are a risk taker, there are several tools to be able to help you out there. And Miss Camille can help you along with Leslie, who are both members of WOW. And I'm going to share the screen. Thank you, Camille. That was amazing. I'm going to share the screen with Camille's information. Whoops. You can reach her at her email, Camille at serenityfinancial.us, or you can go to her website, serenityfinancial.us. Also in the chat, you will find her information so that you can actually schedule a meeting with her. And how much does that meeting cost, Miss Camille?
That meeting is free.
You guys, you can get free information from Miss Camille. Free information. All you have to do is sign up on her Calendly. So thank you again, Miss Camille. We're going to
You're
move
so welcome.
on
Thank you.
to, again, you have a few more seconds if you're looking to be added and possibly winning our giveaway today. And we hope that everyone is touched by our giveaway today. And of course, we have some things coming up. We have our spring bling, Mother's Day is coming up, and our WOW walk, you guys. We don't have the details for that, but it's coming and it's going to be amazing. We're looking for volunteers for the walk and for the WOW Eats and for Mother's Day and for the luncheon. The remaining of the events in blue and purple will all be in person events. Yay! Aren't you glad? I can't wait to love on everybody and see everyone in person. We're going to finish off the rest of this quarter growing your wealth, and the spring bling will be virtual this year, but Mother's Day will be in person. So we hope to see you there. Also, you guys, we have 2 days left. If you are wanting to still be a part of the co-author book for women, it's $125 per person, which comes with 10 books, an author URL, a t-shirt, the book release and marketing graphics. You can be a part of this book. And all you have to have is an empowering story that you've overcome in your life. And if you still want to be a part of the book and you don't have the money, please reach out to me because we don't want that to stop someone that has a story that can reach hundreds and millions of women and improve your economic status. So we want you to be a part of it. Next month, we are having our Spring Bling, and the Spring Bling Resource Fair is going to connect people to education, career, business, health, resources, and vendors. So make sure you're tuned in. It is going to be Saturday, April 10th from 11 a.m. to 1 p.m. Also, you guys, it's $25 for the year. You really want to be a member. We're doing some amazing things. Be a part of it. The $25 is just to keep us going and make sure we are able to market to people and just be a good cause for the community. Be a part of something bigger than you. And this is totally bigger than all of us. So you can also become a speaker, become a member, make a donation, or follow us on Facebook. We want you to be involved in what we have going on, because we know that through you all things are possible. Okay. Let's get to this. Let me get to this drawing. So these are the people that actually put their names on the link to go in. So what I decided, since it was only $5 anyway, we're going to give everyone that signed up $5 to their Cash App or their PayPal. So if you're on this list, Tara Payne, Sabrina Chandler, C Note, Aretha, or Artheta, sorry, Miss Pouncil, and Erica, which I know that's Erica Slade. If you guys are on there, if you could put in the chat your information, we'll be good to go. Your Cash App. If you don't have Cash App, I will be in touch with you myself to make sure that we get you signed up. You guys, this has been amazing. And guess what? For the first time ever, we are going to finish on time. You guys, I hope that your spring break is amazing and that you have been touched today. There was so much good information on here. Of course, we're going to post this to our YouTube. So find us on YouTube. It's WOW Organization. And you can also find us at Facebook, WOW Organization. And if you're a female, you can join our group, which is WOW Network. And it is a private group. So be ready. And I am getting all of I see people have signed up. Have put their information. I'm going to save the chat just in case we end, but I'm going to cancel the live Facebook